The World Bank says there's $100 trillion in institutional assets under their control. We think it could be 1 to 5% in Bitcoin because it is such a nice addition to portfolios. That's $1 to $5 trillion of investment. Right now Bitcoin ETFs hold 170 billion. That means we have a long way to go. So I think they see it as a very exciting asset, an important asset, and one that they're going to allocate to in the coming years. It's a big market. Companies now hold about $8 trillion in cash on a global basis. If you think 10% of that is coming into Bitcoin, that's getting pretty close to $1 trillion, right? Again, the whole asset, Bitcoin as an asset, is $2.5 trillion. So $1 trillion of buying power, which you could easily see from corporations over the next handful of years, is a really lot of money, right? Companies have a lot of money and they're worried about debasement.
Bitcoin isn't just on another run. It's not just breaking out. No, this is the kind of financial earthquake that rewrites the rules of money itself. Right now, Bitcoin is hovering around $115,000, and people think that's wild, but it's just the appetizer. The real feast hasn't even hit the table. Let's put this into perspective. Institutional investors across the globe control a mind-bending $100 trillion. If just 1% of that, just the crumbs, slides into Bitcoin, that's $1 trillion in fresh demand. Push it to 5%? Now we're staring down $5 trillion. Compare that with today's Bitcoin ETFs, which only manage about $153 billion. That's not a ceiling, that's a floor. We're in the first inning of a $1 trillion tidal wave. And it doesn't stop there. Corporations worldwide are sitting on an $8 trillion mountain of cash. Do you think they'll just let inflation and currency debasement eat it alive? Not a chance. Even if just 10% of that cash gets redeployed into Bitcoin, that's another $1 trillion rocket booster strapped to Bitcoin's already scorching trajectory. This isn't retail hype anymore. It's boardrooms, balance sheets, and CFOs waking up to the hard truth. Bitcoin isn't a gamble, it's insurance. Matt Hougan nails it. The perception of Bitcoin has transformed. It's not a fringe bet. It's not internet magic money. Institutions now see it for what it is, a liquid, uncorrelated asset that's scarcer than gold, harder than any fiat currency, and programmed with an unshakable supply cap of just 21 million coins. This is the rarest money humanity has ever known, and the sharks on Wall Street know it. So what happens when unstoppable demand collides with immovable scarcity? Fireworks, the kind that makes the last bull run look like a sparkler on the 4th of July. We're talking about a financial detonation that could reshape portfolios, economies, and the very definition of wealth itself. The last Bitcoin bull run? That was the rehearsal. This one? It's the main event. And when the dust settles, people won't be asking, why did Bitcoin go 10 times bigger? They'll be asking, how did I not see it coming? Let's bring you clips from Matt Hougan's interview. This is an important video you do not want to miss. Please watch, share, and like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for joining us again. Enjoy the rest of the video.
But the reason we took it on, what people may not understand, is that long-term capital market assumptions are sort of the core of how traditional investors in the professional markets allocate to different asset classes. You can't build a portfolio that decides to invest so much in stocks and so much in bonds and so much in real estate and maybe so much in crypto if you don't have any data-driven way to know what to expect from those assets. Is now a good time to invest in stocks or a challenging time? What's the outlook for bonds? What's the outlook for crypto? We've been in the market at Bitwise for 8 years serving professional investors. And until last year, no one had asked me for a long-term capital markets assumption paper on Bitcoin because the largest institutions weren't looking at this asset class. But last year, more than a dozen firms requested it of us. And so we set aside as a team, how do we do this? How do we build up a fundamental data-driven long-term view of where Bitcoin is going over the next 10 years and where it fits in portfolios? And of course, and Ryan will jump in here, we started with what you started with, Bob, which is the macro picture and the need for this insurance against the huge buildup of debt and currency risks that we're seeing in the macro environment.
Why Bitcoin has value.
Yeah, absolutely. This is a question I get all the time because Bitcoin doesn't generate cash flows, right? The reason stocks has value is they generate cash flows. And people always ask me, how do we know Bitcoin is worth anything? How do we know it has any value? And the framing that I used in that write-up is that from my perspective, Bitcoin just provides a service. And the service is the ability to store wealth in a digital format without a government or a bank. And today, hundreds of millions of people around the world want that service. The reason this is a clarifying way to think about Bitcoin, again, it's a service, the ability to store wealth in a digital format without a government or a bank. It's because we're used to services having value. If you think of any company in the world, let's think of Microsoft. Microsoft provides a service, which is the ability to edit Word documents and do Excel and do Teams calls. And people pay Microsoft to access that service. If you want Microsoft service, you buy a subscription to their software. The more people who want that service, the value of Microsoft goes up. The fewer people who want it, the value goes down. And critically, if no one wants Microsoft service, the value of Microsoft is zero. The same thing is true of Bitcoin. The more people who want this service, the ability to store wealth in a digital format without a government or a bank, the value of Bitcoin goes up. If fewer people wants it, the value goes down. If no one wants it, the value is zero. The difference is you can write a check to Microsoft because it's a company with a CEO and employees. You can't write a check to Bitcoin. There is no CEO of Bitcoin. The only way to get the service that Bitcoin provides is to buy Bitcoin. If you buy Bitcoin, you get the service. But other than that, it's simply identical. More people want it, the value goes up. Fewer people, the value goes down. No one wants it, the value goes to zero. What we show in this report is that more and more people want this service. And with US debt at $36 trillion and growing, with money printing going around the world, I think more and more people want the service of storing wealth in a digital format without a government or a bank. And that's what creates the value of Bitcoin. I mean, it's totally crazy. It's out of control, right? Like growing up, we always had debt and deficits and we worried about it. But since COVID, it's exploded. We're running 6 or 7% budget deficits during times of economic growth. Just the interest on the debt amounts to $6,000 for every taxpayer in the US every year. Just the interest. That's like the minimum charge on your credit card bill. And that keeps compounding because we keep spending more and more money. So, the need for insurance is directly related to the scale of the risk. I live in California. The need for fire insurance is high because we have a lot of fires and the conditions are ripe for more fires. In the US, the need for insurance against this fiat debasement has gone from small to really significant, and it's gotten on a life of its own. Like, I think there is no way out at this point. We've tried everything. The government's just going to keep spending money. It's the only thing we agree on as a country is we should print and spend more money. And so I think you need a little bit of insurance, and Bitcoin is exactly that. I think there have been two pretty fundamental changes in the monetary ecosystem over the last 15 or so years. One was after the global financial crisis when we discovered the tool of quantitative easing. And that was not something that had existed in our vernacular. And that really led to a dramatic expansion of money printing. The second one was when the US government seized Russia's treasury assets, when they invaded Ukraine, which was really a signal to central banks around the world that, those assets aren't yours. You're sort of renting them. In the same way, some people are shocked to discover that they don't own the books on their Kindle, that they're effectively renting them from Amazon. It can be revoked. We found out that governments don't own their treasuries. The US can just take those away. And I think that was a shot across the world that central banks need to diversify into, assets that can be held on a sovereign basis. And that's gold. The other thing I would add, I think that's what's driving the purchases. One of the reasons I'm with Ryan that I think they'll move into Bitcoin is, if you think of the history of money, the reason people used gold instead of silver was that silver is too bulky. Gold is much more dense, stores much more wealth per unit. And so if you needed to move $1 billion of gold, you could do that. $1 billion of silver would be basically impossible. Bitcoin is infinitely more transportable, storable, movable, useful, divisible, etc. than gold. And so I do think over time, as this asset matures, you're going to see Bitcoin sitting side by side and then eventually, maybe someday, on parallel with gold in terms of central bank deposits. It's just a continuation of the idea of more dense, transportable forms of hard money.
Long-term capital market assumptions are key for investors to decide how to balance investments across stocks, bonds, real estate, and crypto. Without reliable data on expected returns, building a portfolio is guesswork. Recently, as interest in Bitcoin from major institutions grew, Bitwise created a data-driven outlook on Bitcoin's future role, focusing on macroeconomic risks like soaring debt and currency instability. Bitcoin's value comes from offering a digital way to store wealth without relying on governments or banks. This unique service attracts millions globally, and its value rises or falls based on how many want it. Unlike companies, Bitcoin has no CEO. Owning Bitcoin is what gives access to this service. Growing debt and money printing worldwide increase demand for such financial protection, boosting Bitcoin's value. Two big events shaped the monetary landscape: the rise of quantitative easing after the 2008 crisis and geopolitical moves showing that central banks can lose access to traditional assets. Historically, gold served as a store of value, but Bitcoin's portability and divisibility make it an attractive modern alternative. According to Hougan, it could eventually join gold as a hard money asset held by central banks. Let's return to the interview.
It's so true, and it's so poorly understood. We say these things about gold like it's existed in this one format versus fiat currencies for thousands of years. And that's because most people don't remember or haven't studied gold pre-1971, right? It was $35 an ounce for like 50 years. And before that, it was $22 an ounce. There was a one-time revaluation, and that was fixed, right? Like a flat line. Pull up a fiat, an actual dollar line of gold, and it's just like flat line up, flat line. And then in 71, it goes crazy. Because in 71, we severed that, and suddenly it was measured against fiat currency. One of the things we show in the paper, which I think is really interesting, we think there are a lot of analogies for gold in the 70s and 80s versus Bitcoin today. Again, I know we all think gold is this timeless asset, but in the 70s, there were real questions about what role it would play in society. People described it as a barbarous relic, like something from the past that was no longer relevant. And if you look at the price, what you saw is the price went way up. You know, it went from $35 to over $800. Part of that was inflation, but part of that was the world discovering that gold had a place in society. And once it did, the value of it went up. I think the same thing is happening at Bitcoin. People are discovering that Bitcoin has a place in society and the value of it went up. What we note in the paper is that over time, from about 71 to 97, gold's volatility declined as people came to accept it. Right? In 1970s, it was hugely volatile. We think of it as steady today, but it moved 3% or more every third day. It was hugely volatile, but that volatility declined over time. I think the same thing is happening in Bitcoin. Its volatility is declining over time. Eventually, it will reach some steady state where it's much more valuable than it is today and lower volatility. But yeah, I love that you bring it up. There's so many parallels between gold in the 70s and Bitcoin now that I think people could do themselves a favor by studying it. Institutions are increasingly looking at it. That's the first and most important point. As I mentioned, we received more than a dozen requests for this report. That's because institutions are looking at it. Or if you just think from a big picture perspective, crypto is now a $4 trillion market. That's too big for institutions to ignore. So to get to your question, what do they see when they look at it? They see an asset that has high historical returns. They see an asset that is historically pretty volatile, more volatile than stocks. They see an asset that is liquid. And importantly, they see an asset that dances to its own drummer, that's not correlated with stocks or bonds. It moves in different ways. And when institutions build portfolios, what they're looking for is a combination of assets that work together and where the sum is greater than the parts. And the key to that is having these assets that move in different ways, right? That's why they bought US stocks and international stocks. That's why they buy stocks and bonds and real estate. And crypto is another one of those vectors. So we think institutions are going to allocate a significant amount of capital to this space. The World Bank says there's $100 trillion in institutional assets under their control. We think it could be 1 to 5% in Bitcoin because it is such a nice addition to portfolios. That's $1 to $5 trillion of investment. Right now Bitcoin ETFs hold 170 billion. That means we have a long way to go. So I think they see it as a very exciting asset, an important asset, and one that they're going to allocate to in the coming years. It's a big market. Companies now hold about $8 trillion in cash on a global basis. If you think 10% of that is coming into Bitcoin, that's getting pretty close to $1 trillion, right? Again, the whole asset, Bitcoin as an asset, is $2.5 trillion. So $1 trillion of buying power, which you could easily see from corporations over the next handful of years, is a really lot of money, right? Companies have a lot of money and they're worried about debasement just like the rest of us. I mean, limited supply is the key of Bitcoin, right? There will only ever be 21 million Bitcoin. There's about 19.5 million that's already owned. And every year right now, the inflation rate of Bitcoin is about 0.8%. In other words, about 164,000 Bitcoin get created every year. That's it. That's important in a couple of different perspectives, just to put it in context. One is that compared to gold, it's actually much more scarce, right? The average inflation rate of gold is, call it 2%, sometimes 3%. So Bitcoin today at 0.8% is significantly more scarce. And importantly, that's going down. Gold's inflation rate has stayed roughly the same for the last 100 years because people can mine, they can open new mines, they can discover it in new places. There's no discovering a deposit of Bitcoin. There is only this 21 million, and the amount of new supply is actually going down over time. The report is relatively sophisticated, but if you wanted to boil it down, you could say there's only 164,000 new Bitcoin per year right now, and there is more than 164,000 Bitcoin of demand from institutional investors. There's more demand than supply, and so the price goes up. I think that is a core element of Bitcoin. It's demand inelastic supply, just a fixed amount. The US is a very strong power. It's a strong economy measured on a relative basis. I think there's a chance that that we enter into some version of hyperinflation, which is, I think, statistically measured as 50% inflation per year. I think there is some chance that the world pivots strongly away from dollars to a new reserve currency setup, but it's not the base case, right? So it's like an out of the money call option, something you might want to insure against. I think it adds to the case, but I find it hard to say that is like the most likely outcome over the next 10 years. I think it's certainly possible. Smart people like Ray Dalio are worried about it. I worry about it, but I was sort of building in the base case. Regulation is still a risk. We've made a lot of progress on regulation over the last 2 years, and that's been reflected in Bitcoin's price going up. But regulation is made by humans, and humans are imperfect and subject to different forces. It's entirely possible that we could see some of the positive regulatory strides we've made in the US and elsewhere be reversed in the future. It's very possible we could see regulators introduce new legislation, or legislators introduce new legislation that is harmful to Bitcoin. I would just note that, today's risk is tomorrow's alpha. And I don't mind that there is still all of these risks in crypto. My best guess is the future track of regulation and legislation is more pro-crypto than anti-crypto. And I think if that comes true, it'll be recognized in the price. I think the perceived risk of quantum computing will fall over time rather than increase over time as quantum resistant cryptography improves in the space. And as these things happen, that accretes to the price of Bitcoin.
Matt Hougan explained that gold's role is often misunderstood because many forget how stable its price was before 1971, fixed at $35 per ounce for decades. It only started fluctuating after the US ended the gold standard that year. He pointed out interesting parallels between gold in the 1970s and Bitcoin today. Back then, gold was seen by some as an outdated, barbarous relic, yet its price increased dramatically, showing people rediscovered its value, especially amid inflation. Over time, gold's price swings calmed, reflecting broader acceptance. Hougan believes Bitcoin is going through a similar process of gaining societal recognition, with its volatility slowly decreasing. Institutions are increasingly interested in Bitcoin, now a $2 trillion market, because it offers high returns, liquidity, and low correlation with stocks and bonds. They value assets that behave differently to reduce risk when combined in portfolios. He noted Bitcoin's supply is tightly limited to 21 million coins, with only 164,000 new coins created yearly, a scarcity much stricter than gold's, which can still be mined and added. Matt Hougan also mentioned that regulatory risks remain, though progress in recent years has been positive. Regulations could shift, but as crypto adoption grows, he expects regulators to lean more pro-crypto. Finally, on macro risks, he said while fears of hyperinflation or a shift away from the US dollar exist, these aren't the most likely outcomes, but factors investors watch closely. With institutional interest growing and Bitcoin's price showing resilience, do you think Bitcoin will become a major part of investment portfolios soon? What's your take on Bitcoin's role as a hedge against inflation and currency risks? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.